not only are we outperforming, if you get to the next page, page 6, we're doing it with significantly less risk than those indexes. And here's where that all comes in. So this is just a simple scatter plot. I'm sure you've seen these before, but it's a risk-return comparison by standard deviation. All you need to know here when you're talking to your clients is, look, Northwest is best, up and to the left, whatever you want to call it. We're giving you more returns for significantly less risk. We're taking about somewhere between 15 and 18% less risk when you compare the standard deviations of the S&P and the Dow Jones versus this strategy blend of the Aristocrats and Value Line Safety.
Okay, 5-year roll.
Next page. Page 7.
Yeah.
And this is where I get back to the whole point of a UIT being an investment solution, not just for 15 months. I know I told Pat this on our first call. The only time I get significant pushback is when that first UIT matures during a pullback. When you see that red number on the board with that first one. But that's why we have this page here. If you give us 5 years, we're 16 for 16 in 5-year period since 2000, giving you positive performance. We're beating the S&P 63% of 5-year periods, beating the Dow 81% of 5-year periods. Math wins over time. Next page is the same thing with 10-year periods. 11 for 11. And I like to highlight here, your worst 10-year period with this strategy is annualized returns of 6.67% per year. That's the worst. 82% of 10-year periods were beating those big indexes. And we're doing so by taking less risk, winning by not losing. I like to hammer that home as much as I possibly can. And then if you go to the next page, you'll just see how we're allocated versus the S&P. You know, we're overweight industrials with this blend, overweight financials, overweight staples. Staples helped during the pullback, but you know, you can see we're super underweight technology. You can see the blend of U.S. to non-U.S. You can see the yield number, which is that historical distribution analysis number right there. This is a portfolio that yields 3.15% per year when you blend these two together. And then on page number 10, it's the 52 stocks you own invested in these two strategies, listed by the weighting, which includes market movement through whenever I ran this for you, through 422. And then the best part, page 11, just 3 stocks overlap between these two UIT strategies. How can you do that with a mutual fund? You don't know what's in there except for maybe twice a year. You know with confidence that you're not buying 2 funds that are buying the exact same stuff. You know with confidence you're buying UITs that a manager isn't going outside their mandate to go chase some returns. Now, these strategies aren't specifically large cap value or large cap growth, but we know how much that happens in the mutual fund world where you got some style drift. So these are really powerful tools that I customize. I run these for Pat quite often, as well as a few others in the office. But this type of proposal is available for my 100% math-based UITs, which is about 21 of our 150 UITs on the shelf at a given time. Sorry, headset died. If you want to pull up the Aristocrats fact sheet, just want to show you what our fact sheets look like here. And just go to page 2 where we're going to show you exactly how we're screening the Aristocrats index. Things we're looking for: companies with low debt, price to cash flow, return on assets, all that good stuff. You can see with this portfolio in particular, this particular series, the 25 stocks have raised dividends for an average of 38 years, even though the minimum requirement is 25. And they're not just raising dividends a penny either. So I'm on the bottom left-hand side of page 2 there, Pat.
Yep.
You can see the annualized dividend growth rate of the companies in the portfolio. It's not a small amount. They're not just increasing a dividend by a penny just to stay on this list. The 5-year average is 6.5%. Now, we might get them in. This number might come down a little bit just as these companies are in the middle of this whole thing we're in the middle of and just trying to stay on this list. They might just increase it a penny this year, but that's a strong number looking back. And then you'll see a very similar set of charts and numbers to that proposal I just showed you on the next page, page 3. You got the mountain chart, you got the risk return profile, the average annual returns. And again, we know we underperform over the last 5 years. What has led the market the last 5 years? It's been large cap, tech, and some of the biggest names in the index. Eventually, there's going to be some more people looking a little farther down in terms of some smaller names, and we'll see more market participation. But we're okay with that, with this type of strategy. That's not why we own it. We own it because these companies have raised their dividends for 25 straight years and have done so in every market environment. And then again, page 4 will give you the yield as well as the QSIPs to purchase. So I will pause here and say, when we get to the point where you're buying UITs, that's where you're going to give me a call and I'll walk you through the first couple tickets. The hurdle or the obstacle that I've run into with a lot of the Transamerica folks has been, you guys deal direct on your mutual fund business. We don't do any direct business. So we work with third-party clearing firms like Pershing that you guys work with, Fidelity, et cetera. So I know Pat has patented the process, pun intended, of getting you guys comfortable with signing clients up for Pershing brokerage accounts. I'll defer to him there briefly. I forget the guy's name that you always refer me to because I'm not at the office with my Post-its, but while you're talking, I'll switch the battery on my headset. All right.
We can hear you.
Good. Let's go to the DESA proposal, if you will, Pat.
And then
So that's kind of,
and we're going to go for about 12 to 13 minutes more, okay?
yeah, I got you. I'll bring it home. So if you pull up the DESA proposal, this is as complicated as UITs get. This is our solution to the Go Anywhere mutual fund, the balanced mutual funds. If you look at our strategic allocation lineup of UITs, 8 out of 10 times we're going to beat those balanced mutual funds. There's some good ones out there, but for the most part, that category in particular, we've had a lot of success beating with our simple math-based allocation portfolio. So this is the all equity anchor of our allocation lineup. I've got 1 tickets at 100% equity, 75 equity, 25 fixed income, 60-40, 40-60, 100% fixed income. And then you can use the 100% equity, 100% fixed in any combination for clients based on their risk tolerance. But this is the core piece of it. If you scroll through this proposal, on to page number 3, you'll see this isn't a typical equal weighted UIT. We've got some market cap weighting going on here, but you're getting 210 stocks, evenly split between growth and value. You're getting large, mid, and small, and a 20% international sleeve. And even with the mid, small, and international sleeve, we're taking on about 10 to 15% less risk than the S&P, which is all large cap, all domestic. Same type of thing, just going through the proposal quickly. Page 4, 18 positive years, 4 negative years. Page 5, we put it up against a couple different indexes. Obviously, the S&P 500, all large cap. S&P 1500 is domestic, large, mid, and small indexes together. And then the MSCI All World is probably the closest comparison, which has domestic and international equities in there. And you can see it's not close when you look at the other indexes. This goes back to 1998. a little bit longer track record here. Page 6, similar type of risk return as the previous one that I showed you. We're a little bit lower on the average annual returns here because small and mid and international have underperformed lately, but over time, over the long haul, we're giving you superior returns with less risk. 5-year numbers look pretty good. 18 for 18 giving you positive returns. 10-year numbers are great. 13 for 13, worst 5-year period, 5% per year.
And why don't we jump into some of the sector focus strategies, if you don't mind?
Yep. I'll skip over to 5G at that point. So what a lot of people use UITs for, not just core holdings, not just dividends, not just allocations, rather than going out and buying a couple stocks on your own, why not pick one of these UITs in a particular area of the market, professionally selected basket of securities, equal weighted at 25, 30 different stocks, so you're not putting all your eggs in one basket. This is how a lot of people use us when they want to go overweight a stock, because they can see the names in there, they can show the names to clients. It just makes a whole lot of sense to spread out your risk rather than go buy a whole technology index, for instance, which is a market cap weighted index. The biggest names have the biggest weight in those indexes, and you're going to own everything. And as I said earlier, we can be a little nimble. 5G. You can download a full-length feature film in seconds. Scroll through the holdings here. Pretty straightforward. A lot of big companies you'll know, some companies you won't. But that's just a pretty simple, easy, straightforward strategy trying to find out what's next in telecommunications.
I think
5G is going to go ahead.
Yeah, I was going to say, I'm getting a lot of calls. Hey, Pat, I'd like to get into the market. Not sure what I want to get into. I think that, maybe technology is the way to go, or if we educate them on the next generation, and let's say they got $5,000 they want to start with. Well, how are they going to buy Alphabet, right? Come on, right? So I like this because it's very transparent. It's not overwhelming as far as the holdings go, and it's specified, and it's a great way for someone to get into the market without needing a huge amount of capital to do it.
Yeah, you could go buy 3 shares of Google, or you could put $5,000 into these 25, 30 names and get diversification for pretty low entry point.
Yep.
And then throw up the American Recovery for me. I'll touch on this one quickly, but 4 years ago, 2016 election, we have 2 portfolios ready to go under our election portfolio umbrella. Red portfolio, blue portfolio, depending on who wins, that's the one we deposit. And we'll do that again come this election cycle here. But that was a 2-year portfolio that was up 38% at the end of 2 years after the election in 16, as we went with the Republican-focused portfolio. This is kind of our answer to that for everything going on with the government shutdown related to COVID-19. It's not companies that'll benefit from defeating COVID-19. It's just the companies that'll stand the tallest on the other side of this thing. This is a 40-stock portfolio, 2-year portfolio, all large cap, all domestic, in 5 sectors we feel we want to be invested in because they'll bounce back the fastest coming out of this. So it's going to be heavy in technology and healthcare. 48% of the portfolio is in those 2 sectors. And then you've got some names from communication services, discretionary, and industrials. This deposited on April 21st, and we've seen $150 million in 2 weeks in this portfolio. It's just an easy story to tell. Looks great on the client statement, American Recovery, and it's got some great names in there too. And Pat, I know you guys are getting up on time, but I want to at least put up that last slide and give you kind of a quick overview of who is First Trust and why we do what we do.
And then also I want you to talk a little bit about Brian Westbury and how they can sign up for his weekly email and how to reach out to you to get on that email list for when you guys do your calls.
Absolutely. So if you got that last slide up there,
Yep.
First Trust is a private company here in Wheaton, Illinois, just down the road from a lot of you. I live a mile from the office. I'm in my basement in Wheaton right now. But we do not have a retail presence. First Trust was founded in '91 as the firm who aligns ourselves with you, the broker, the financial advisor, or as our CEO Jim Bowen puts it, it's you are the guardians of the wealth of the most prosperous people in the world. We do not advertise. You'll never see our name on a stadium or a TV commercial. We're the largest UIT sponsor. We have 75% market share in the UIT space. It's a 60, 65, $70 billion a year industry that is really not as big as you might think, or could be a lot bigger, and it's growing every year. But we got this little niche of the investment world that we just own. We're also the 6th largest ETF provider. We're the largest active ETF provider. We've been ranked each of the last 2 years as #1 fund family by Barron's for U.S. equities. And we've been either in the top 10 or top 5 even for the last 8 years in U.S. equity. But really what we do is we spend 100% of our time, energy, and resources on partnering with you, the financial advisor, helping you and your clients grow their business. So we're compensated a little differently than most wholesaling firms. You know, most mutual fund wholesalers are paid on sales, gross sales. We are paid on AUM and total sales, meaning we're not compensated to get you to move from one fund to another. It's in our best interest to get you ideas and solutions that helps grow your client's business, because over time, as your client's assets grow, so does your paycheck, so does ours. So it's truly rising tide lifts all boats with us. And as far as the resources we provide, we're in our 9th consecutive week of doing daily 10 a.m. conference calls since the start of this thing. And that's been everybody from our chief economist and award-winning economist team, headed by Brian Westbury. If you don't know that name, Google him. He's on Fox News all the time, but really he has been doing this so long, I don't even know how to give him a proper introduction. First Trust was ranked as the most read and most shared economic team from any major product partner or economics group by financial advisors. And that was a survey 2 years ago from advisors across all channels: bank reps, RIAs, wirehouses, insurance reps. #1 is most read and most shared. Brian Westbury every Monday morning comes out with his Monday morning outlook, which not only is client friendly for you to share, it's client friendly for your clients to understand. If you haven't seen my emails, I send out the Westbury update every Tuesday morning. First thing, I wait till Tuesday because sometimes we get it at 10 a.m. Monday, sometimes we get it at 3 p.m. in the afternoon. So you get it from me before market opens Tuesday morning with a quick UIT idea. But the Brian Westbury piece, if you're not already sending it to clients, I highly recommend you start, or at least cherry picking a few to do so. Because not only has he been right about the economy more often than not, and more often than most economists, he talks about the economy in a way that anybody can understand. Whether you've been in this business for your entire career, whether you know nothing about the economy, he makes it all really simple and straightforward. So if you're not seeing weekly emails from me, let me know. You can go to our website, ftportfolios.com, and have your clients sign up to receive that directly from us on the public side of our website. And really, when you look at the conference calls we've had the last couple weeks, I have all the replays available as well. So you can go hear what Brian said 9 weeks ago on our first call on March 10th and compare it to what he said this week, Wednesday, yesterday. And he's been as consistent can be, that we need to open this thing back up or there's going to be more damage than it was worth. But regardless of your political views, Brian will give you ammo for your conversations with your clients I use his talking points very regularly as well, but I can't give him a more glowing plug than that without getting more in depth. But I think that kind of covers it for me, Pat. Did I leave anything out that you're using from that we've been sending?
I think, guys, if you want to really start on the economy, that is during this.
I don't know if it's just me. You're breaking up on me pretty good.
Is that better?
Much better.
All right. I was just going to say, I was saying is that the Brian Westbury stuff has really, really helped me during this COVID crisis of being able to have intelligent conversations with my clients about where we're at with the economy. Like Ed said, if you have no understanding how the economy works, this is something you got to jump on. My connection is getting worse. I apologize. Ed, thank you for your time. Does anybody have any questions? I think there was some in the chat here. I think I've covered some of those. You talked about the description on that. Anybody have any specific questions they want to ask? Maybe raise your hand and I can unmute you. I don't see anybody. Oh, I think we got one here. Is that you, Susan? Okay, Susan, you got a quick question. We have just a couple minutes here because we got to get Todd to wrap up this call for us. Go ahead, Susan. Susan? Okay. All right, I think we lost Susan there. Ed, can you still hear me?
Yes.
Okay. Listen, thank you for your time. If they want to get a hold of you, can you provide your
can you hear me?
Or email address?
I think we got Susan first. Hang on.
Can you hear me? I'm on my phone,
Yeah, go
not
ahead,
the
Susan.
computer
Yes.
speaker.
Yeah, go ahead.
Okay, thank you. So I have two clients in mind who may be interested in investing in UIT. It would be their first time as well as mine. So I am wondering, may I reach out to you to help walk me through the process and the application and submission?
Yeah, that's why they pay me the big bucks. I'm available, and as Pat will tell you, I'm back to you quickly if I'm on the other line. So please do. And here's my contact info for those of you in Chicago suburbs. I do not cover downtown, except I do cover your Chinatown office. I don't know if we have anybody on the call from that office or not, but I'm Northwest Indiana, Chicago suburbs, out to 355. My direct line is 630-765-8663, 630-765-8663. My email address is McCaskey, McCaskey, at FT, as in First Trust, portfolios with an S.com.
And folks, so Ed will help you everything on the First Trust side, getting proposals together, help you understand the UIT, what's appropriate possibly for the risk tolerance of the client, or at least give you some ideas. Again, I would highly encourage you to, if you need help with the client specifically, to reach out to your SMD or securities license rep who's maybe done these, and they can maybe assist you on the first one. Also, once the client has agreed to move forward, you have to do this through Pershing. The phone number from Michael Rowe, who is our contact at home office, that will help you get set up on Pershing to do the trades. And once you've done one, it's really quite simple, okay? His phone number is 727-557-3997. Once again, 727-557-3997. And his email is michael.rowe, and that's ROWE @transamerica.com. He helped me really get set up on my first one, our first couple, and then once that was it was really easy. So Ed, we want to thank you for your time today. And great as always. And be safe. And we'll talk to you soon. Okay.